Now, beyond long-term holds, we see the point where traders are separated from investors. Traders are people that are aiming to profit off of short to medium term fluctuations in a market. And different types of trader includes swing trading, day trading, and scalping. First type of trading that we'll talk about is swing trading. Swing trading focuses on price fluctuations on a short to medium time frame, with the main idea behind swing trading being that you want to catch market swings that could play out over the course of a few days to even weeks. Now, swing traders typically hold positions longer than day traders, but they hold them less than buy and hold investors. So not quite holding them with the intent of holding the asset for years or maybe even decades, but more so holding it over the course of a large amount of hours, maybe days, weeks, arguably even months on some extreme cases, but generally that type of time frame, a longer time frame than someone that's just trying to buy and sell on the same day. Now, swing trading works best in trending markets where strong trends on higher time frames, such as the 4-hour or the daily, can provide plentiful opportunities of large price swings to take advantage of. Swing trading becomes much more difficult in consolidating markets, though, where price action is moving sideways and there's little price fluctuation and little price volatility to be played off of. The main idea of swing trading, we want to see swings in the market. We want to play off of those swings where we're either buying at the bottom and selling at the top, or we're shorting at the top and selling and closing your position at the bottom, whether the market is trending upwards or trending downwards. Medium to high time frames are favored by swing traders, and this includes, but is not limited to, the weekly time frame, the daily, the 12-hour, the 4-hour, and the hourly charts. Now, intraday time frames such as the 1 hour, maybe the 30-minute, or even the 4-hour, these can be used for specific entries and exits within the greater trend established by the daily or the weekly. And this is where we start to see a combination of time frames being utilized, where we're basing our trade idea maybe on the daily, and we're going to use the 4-hour as an entry point, right? We're seeing that there's generally some sort of uptrend on the daily, and maybe we're seeing a dip or some sort of downtrend in the 4-hour or in the 1 hour. Maybe we want to enter in at some sort of bottom that we can establish. All right, this is some sort of level of support. It looks like price could turn around and continue upwards, and the daily has continued to point upwards with its general market structure, so that could be a potential entry. And this is where we start to use these smaller time frames to support our ideas generated on the larger time frames. Now, swing traders will often use combinations of technical analysis and fundamental analysis to inform their trade entries and exits. And this is where we start to see this combination of FA and TA come into play. When it comes to fundamental analysis, sometimes this takes multiple days, maybe even weeks to play out. And since swing trading favors these longer holding periods compared to scalpers or intraday traders, they are more primed to take advantage of fundamental changes and pumps and price changes, volatility as a result of these fundamental updates. Here's an example. This is Polkadot on the 4-hour. This is a potential swing trade taken towards the later period of September, where we're seeing this general downtrend, lower lows, lower highs. We start to see a potential shift here. Price comes down here, forms this extreme swing low. Price comes back up, forms a lower high than the highs established before it. So we're still seeing this downtrend. Up until about here is when we start to see a potential shift or a slowdown in the trend. We started to see this swing low. It's a higher low than the one observed before it. And then we do see another consecutive low than the one before it. This is still a higher low than this greater swing low observed on the 21st or the 22nd. We come back to here. Price comes up, produces a high. Comes back down, produces a higher low than the one before it. Once again, this is just another indication that, well, there's some sort of slowing down, right? We're starting to see some sort of curvature on the bottom, indicating that there is a pause in this downtrend and may be weakening at this particular point. Let's say price came down to here. We entered at some point. Let's say we entered around here. We could have rode this up as a swing trade over the next 17 bars, I should say, which is 2 days and 20 hours worth of time. And we would have profited about, at a maximum, at the very high, of about 26.5% over 2 days and 20 hours, which is pretty significant. It's a pretty large swing trade. So once again, we saw that beginning of the reversal from the immediate downtrend started on 9/23. We saw a double bottom observed. We're on 9/28 at 8 p.m. Price falls to $26.11, and on 9/29 at 4 p.m., price fell to $26.41. So generally, bottoming out in the same range, and also the indication that price falling to this new low, which is a higher low than the one observed before, is indication that that previous downtrend may be starting to weaken. We failed to produce a consecutive lower low, and generally we could interpret it as a double bottom. We could also interpret it as a higher low, even if it is only 30 cents higher. Now, the failure by sellers to produce a lower low on 9/29 indicated that sellers were losing power and that buyers could take over the market momentum, which they did. From the second higher low on 9/29 to the highest price point on October 2nd at 12 p.m., Polkadot increased 26.5% in 17 bars, or 2 days and 20 hours. The next type of trading we'll talk about is day trading. So day trading is a trading strategy that focuses on entering and exiting positions on the same day. It can also be referred to as intraday trading. The goal of day trading is to use intraday trading strategies to profit off of price changes in an asset. Day traders never leave positions open overnight. Day traders aim to profit off of market volatility, which is what generally all traders want to profit off of. We want to see market volatility regardless of our trading preference. Volume and liquidity are extremely important to execute quick trades. As a result, day traders typically will favor highly liquid market trading pairs. Some examples include Bitcoin to US dollar and Ethereum to the US dollar. Day traders would typically use technical analysis to inform their trades. Important factors to consider for entry and exits are volume, price action, macro and micro trends, chart patterns, and other technical indicators. Now, one of the biggest differences between day trading and swing trading is that, once again, day trading, you're closing the position on the same day, right? Let's say you enter the position at 10 o'clock in the morning, you're closing it by 5 o'clock. You're closing it by 6 o'clock. You're not leaving it overnight. Once it becomes an overnight trade, that's when we're considering it as a swing trade. And with that in mind, fundamental events, updates, protocol changes, etc., these may take too long to play out because they might take several days or several weeks to play out for. And as a result, day traders may not be able to fully take advantage of these situations. Some day traders base their strategies around trading the news, profiting off of announcements and events on a day-to-day basis, but they're not quite letting their position sit over the course of 26 days as price runs up for a protocol update, just like a swing trader would. Once again, risk management is crucial when entering any trade, and particularly for day traders, having set stop losses is quite crucial because with any trade, the market can and will go against you at certain times, and being able to move in and out and have defined points of loss, particularly as a day trader, is crucial in preserving capital over the long term. Now, one basic day trading strategy is simply range trading. This is where traders look for price ranges within the market structure, and they trade based off those ranges. For example, if Bitcoin is fluctuating between 42,000 and 44,000, a range trader could buy or long the support level, and they could sell as price nears the resistance level. The main idea is based on the assumption that the boundaries of the range will hold as support and resistance until the range is broken. The lower edge of the range support will push price up, and the upper edge of the range, which we can consider as resistance, will push the price down. It's also important to note that the more instances price touches a support or resistance level, or the more time spent at that level, the more likely that the level will break. Good range traders will always prepare for the chance that the market will break out of the range and move against the trade. And this involves using found risk management and having a stop loss set at a level where a breakout from the range is confirmed. Here's an example. This is Bitcoin on the 1 hour chart. And as we can see, we could have identified these ranges, right? We have these clear ranges identified. Let's say 40K is some sort of bottom, and then 41, 42, 44, and 45. And now this isn't necessarily done just based on random numbers. We could have looked towards Bitcoin's past price action and particularly noted where price seemed to have stalled out from progressing, right? Like we see clearly price came down to here. There was a level of resistance. Price fluctuated here. So this is some sort of predefined area. We also see price come up to here. Once again, here, there was a bit of a pause in this upward motion. Price generally just broke out of it though. And we see the same thing with each of these sections. Price coming up to here was rejected down. Price rejected down to 41K, overall held, and it comes back up to this 42K. A bit period of consolidation. This would have been an opportunity to take profits if you long down here. Let's say price comes down to here. You could have profited off a short from this top area. Or let's say we're in some sort of downtrend. Price comes down, it comes back up to here. Maybe you could have opted to open up a short position. Let's say you open up a short position here. You could have taken profits if it came down to here. You knew that this was the next level of support. Price comes down to here, acts as support, comes back up. This is another indication. We could have taken profits here. We could have taken profits here. Price comes back down. Maybe we want to enter another long. We enter a long, it comes back up to here. Start taking some profits. It comes back down. Maybe we re-enter. We could take profits here. We can also take profits up here, right? There's multiple instances, and this is where being able to identify key ranges, key levels of support and resistance can come into play, because this is where we're going to plan around our idea of taking profits. We want to take profits as price is reaching those levels of resistance. Maybe not full profits. Maybe we take a portion of our profits. Maybe we'll take a third of our position. We'll take half of our position. There's multiple ways to approach this. So in the above example, we saw the 1 hour chart of Bitcoin US dollar focusing on a 921. to October 1st. We saw Bitcoin fall through several pre-established support levels of 45K, 44K, 42K, 41K, and 40K. It established a lower low of 39.6 K on 9/21 from the low shown on September 20th. The lower low on September 21st is a sign of a bearish indication and the potential of a downtrend, a continuation of the downtrend or establishment of it. Remember, we don't know what will happen next in real time. A new lower low must be formed to confirm the downtrend. And as shown above in the green arrows, the successive lows are higher than the one before it, overall signifying a bullish movement in the market. We're starting to see a build up from the bottom upwards. The floor was raising. Now, using that lowest low as a point of reference, we can assume that any price movement below $39,600 would invalidate any long trade above it. Therefore, we can use 39,600 as a stop loss level. Just in case the market decides to move against us, this is where we want to start considering it, that pivot low, that swing low. On September 24th at 7 a.m., we saw that Bitcoin fell from 45,000 to just below the 41,000 support level, but ultimately closed at 41.5K. We see a continuing downward movement until 9 a.m., where the first signs of a short-term reversal are found. And we saw on that 9 a.m. 1 hour candle that the open was $41,198. The high was $42,018. The low, $40,872. And the close was $41,863. We also saw that on 9/24 at 9 a.m. and 10 a.m. that buying volume overtook selling volume and spiked during these hours while price rose to a high of 42,720. Let's just go back to that for a second. This is on 9/24 right here. This is particularly noticeable here, right? We've reached this high and we failed to overcome it. As a result, notice how volume, as price is coming up, volume does seem to generally be coming down and then spikes. It spikes as price is rejected, indicating that there is a greater desire to bring the price lower than it was to bring higher, right? There was much more buying and selling activity. And as a result, since price came down, there was a higher amount, I should say, of sellers, because if there was a high amount of buyers, price would have went up. We do see this particular spike as price comes down. This is an indication of capitulation, as we see here, and a bottoming period. We want to look for these high periods of volume as a level of bottoming, right? This is a sign that there's some sort of exhaustion, seller exhaustion, buyer exhaustion. So price comes up to here, level of exhaustion, and does perform a bounce back up to the upside from about 41,000 to, let's say, about 43,000. Now, a position could have been opened at that lower level with the assumption that the 42 or 41,000 support level was held since price did not fall lower. Buying volume spiked and overtook selling volume. The position could have been closed approaching the 42,500 resistance level. It's important to note, though, that price will not always go up to the resistance level in the range, as other traders and bots are often using these same lines in their trades. These traders may sell prematurely before price hits the upper range to ensure that profits are taken before others do. We'll also talk about scalping in this next section. So scalping is a trading strategy that focuses on small price fluctuations in a short period of time. Scalp traders or scalpers do not seek massive percentage gains in a single trade. Their goal is to make multiple trades based off of small price changes over and over again. The idea is to make multiple trades with small percentage gains that compound over time, which add up to a significant amount in the long run. Now, scalping heavily relies on technical analysis to base trades off of. Most fundamental events, such as protocol events, changes, updates in the news, those play out over a longer period of time, typically. So the event alone will have a lower impact on scalping as opposed to, say, swing trading. Swing trading may be able to take a greater advantage off of that. Scalpers, they might be able to take a few trades off of it, but they're not going to see a significant increase that a swing trader would, where they could play off of that fundamental event and maybe make a 20% play. Fundamental events can still have an effect on other factors, such as increased interest and volume and higher liquidity compared to non-event trading periods. So scalpers may be looking for those events for that particular day or for that particular hour because they might see those events as opportunities for volatility. And remember, as a trader, we want to see volatility. That's really where we make profits off of. It's not when price remains steady or when price remains constant. We want to see fluctuation between highs and lows. Once again, scalpers look to exploit short-term bursts of volatility over larger price movements. As a result, these types of traders will favor shorter time periods generally, and they'll generally look towards the 30-minute, the 15-minute, the 5-minute, the 1-minute, maybe even shorter. And as a result, this type of strategy is not ideal for everyone, as it requires an advanced understanding of market movement and very quick decision making, often under a lot of stress. And once again, they might be basing their trades off of the 30-minute, the 15, the 5-minute, but successful scalpers, they're still taking in consideration the larger time frames. Remember, all of these lower time frames are still happening within the greater trend, the macro trend. What's happening on the daily, what's happening on the weekly market structure. All of these time frames are happening within that. So let's say there's a large shift, a large trend in the daily. Scalpers, or these smaller time frames, they're just small movements, small patterns, small zigzags within that larger swing on the daily. So people that are scalping or even day trading, they're just playing those small micro movements, those small micro patterns within the larger time frame. So it's still important to consider the larger time frames for guidance and just general understanding of the macro movement of the market. Scalpers generally use this information to move within the greater trend and just to give more general direction to the market and in regards to their trades and where they're going to base their trades and how they're going to base their trades. In regards to scalping and entries, they're looking for patterns and price action, seeing if price hits a low or support level multiple times to identify bottoms in a market pattern. Once identified, a trader can select a price point slightly above this low to ensure that you don't miss the move up. And in regards to scalp trades on the 15-minute or lower time frames, this can be profitable during FOMO pumps, protocol updates where there's a lot of talk, there's a lot of social media discussion, there's a lot of price volatility in the asset itself. Project announcements as well will see sudden bursts of volatility, and speakers and statements from the project or even government officials, maybe just important figureheads in the space. Sometimes when they have conferences and interviews, this could have a positive or a negative effect on the market, and as a result, scalpers are able to take advantage of those small price fluctuations.